I'm Agni Chaudhary, an SMSF Specialist Advisor, and today we shall discuss the nitty-gritty of ECPI deduction. It's a topic very close to my heart. I've provided support on this product for Trustdeed for many years, so I've decided to have a discussion on this very complex area of SMSFs. Briefly, today we shall discuss what is ECPI, what methods are used to claim ECPI, some real-life scenarios which I hope clarify our concepts of ECPI, and lastly, how to claim expense deduction when fund is claiming ECPI deduction. Before we proceed, I'd like to remind you that I've uploaded your handouts for you to refer to. So let's quickly dig into this very interesting topic. This slide is a general disclaimer that this is general advice. It's very important to read before we continue. So what is current exempt pension income? ECPI provisions are perhaps some of the most important in the taxation of SMSFs. They achieved the design intent that pension benefits are only taxed, if at all, once, and that is at the point of the recipient. They have the effect of making the SMSF a pass-through for tax, as earnings on assets supporting pensions are ignored at the fund level and only taxable before age 60 at the member level, subject of course to a tax offset. When the SMSF is paying a pension, the income supporting that will be exempt, and the taxable component of the pension will be entitled to a 15% tax offset. More importantly, because benefit payments, including pension payments, made from a taxed superannuation fund to a person over age 60 are not taxed at all, it is important for recipients of pensions over the age of 60 that the earnings on the fund that is paying the pension are also not taxed. Which brings us to the question when an actuarial certificate is needed. If an SMSF has unsegregated assets, that is, accumulation and pension assets are mixed, and paying an income stream benefit to a member, then you need an actuarial certificate every year to claim exempt pension income. This income is commonly referred to as exempt current pension income, or ECPI in short. The actuary's role is to calculate and prepare a certificate which determines the percentage of tax exemption from the total ordinary income. Each year, you need the certificate before your fund is audited. An SMSF is in pension phase when at least one member is drawing an income stream benefit or pension, usually an account-based pension, from the fund. When all members of the fund are drawing an income stream, then ordinary income earned by the SMSF is exempt from income tax, and you do not need an actuarial certificate. But when an SMSF has a combination of both types of members, that is, some members of the fund are in accumulation phase and some members are withdrawing a pension. Further, if the fund is a one-member fund, say for example, the member has a pension account and is contributing to the fund, such as in a case of a transition to retirement income stream, then the fund needs an actuarial certificate. When the fund's assets are not segregated, that is, accumulation assets are not separate from pension assets, then part of the fund's income could be taxable and part could be exempt. To claim this exemption, two methods can be used, which we shall discuss very soon. Here, it is important to note that this exemption only applies to ordinary income, such as income, dividends, rents, and distributions. It does not apply, for example, to assessable contributions, non-arm's length income, or nully in short, or income from segregated assets. We will look at several examples of this going forward. The two methods by which the trustee can calculate the portion of the income of the fund related to pensions that is exempt and taxable are the segregated assets method. This is where assets specifically supporting a pension are set aside, like investments in term deposits or shares equal to balance in pension accounts. These assets do not mix with other assets of the fund. Or the unsegregated assets method, where assets representing accumulation balances and supporting pensions are mixed up and cannot be separately identified. The key here is that it cannot be separately identified. The segregated pension assets method requires that investments of the superannuation entity are allocated between those that are being used solely to provide certain pensions and those investments that relate to the accumulation phase of the fund, including any reserves of the fund. Where a superannuation entity is determined on a segregated pension basis, and provides allocated pensions, market-linked income streams, and account-based pensions, then the segregated pensions method can be used to determine the exempt pension income. Where other types of pensions are being paid by the superannuation entity, the unsegregated assets method must be used. Determining the segregation of a fund's investments can be a complex process and requires a clear division of all relevant investments. For example, the fund would require separate bank accounts to identify the income arising from investments used to support the pension and those used for accumulation purposes. This method may prove much more costly than use of the unsegregated assets method. However, it can be useful if there is a disproportionate amount of income and capital gains being earned on the investments supporting the pension. Assets will be segregated current pension assets if they are 1. Assets that are invested, held in reserve, or otherwise dealt with solely to enable the fund to discharge income stream benefit payable at that time, and the trustee has obtained an actuary's certificate before lodgement of its return that the assets and expected earnings from them would pay all or part of the pension liabilities. The exemption excludes non-arm's length income and assessable contributions. In the example provided here, pension assets such as cash and units in a unit trust are clearly segregated, whereas accumulation assets include property and shares are separately identified. The situation will not require an actuarial certificate. So when is an asset a segregated asset? Let's consider some background information first. Some time ago, the Commissioner issued Tax Determination 2013-D7, which considered the circumstances in which an asset will be taken to be a segregated current pension asset under Section 295-385 ITAA 97. However, a number of submissions raised concerns about the Commissioner's interpretations, which resulted in its withdrawal. In its place, the ATO has issued Tax Determination 2014-7, which provides guidance around when a bank account of a complying superannuation fund can be a segregated current pension asset under Section 295-385. In order to be a segregated current pension asset, an asset is required to be invested, held, or otherwise dealt with solely for the purpose of discharging pension liabilities. When a bank offers sub-accounts to its customers, the ATO takes the view that a sub-account will be treated as a separate bank account. That is, the ATO accepts that a sub-account can be treated as a segregated current pension asset. According to the ATO, one important characteristic that distinguishes bank accounts from other assets is that such an asset can be easily divided into smaller assets, which is with each asset, having the same nature as the original asset. For example, a bank account with a total balance of $100 and notional sub-accounts of $30 and $70 is effectively the same as two bank accounts with separate balances of $70 and $30. Legislative support for this view is also provided by the banking regulations. Similarly, the ATO also takes the view that notional or virtual sub-accounts are treated as sub-accounts, but only where proper accounting records are maintained. The ATO noted that large funds may use accounting software to break down actual bank accounts into virtual or notional sub-accounts for a member. For example, to distinguish between the member's accumulation and pension phase benefits. Note in the ruling, the ATO does not limit informal or notional sub-accounts being counted as segregated assets for large funds. Instead, the ATO accepts that informal or notional sub-accounts may be utilized by other parties, for example, a superannuation fund trustee, provided that proper accounting records are maintained. Hence, provided that transactions and balances are clearly recorded and reported to enable the amounts in a notional sub-account to be readily determined, the sub-account can be a segregated current pension asset. In terms of the day-to-day issues that may arise with segregated bank accounts, the ATO makes the following comments. Receipts and outgoings paid from the one bank account. If amounts relating to both segregated and unsegregated bank accounts must be paid from a single bank account, the Commissioner states that a transfer or set-off between the bank accounts must be done within a reasonable period of time. Interest income. If an amount is transferred between bank accounts, as described above, any interest earnings on receipt or outgoing must also be transferred to the correct account within a reasonable time. Superannuation contribution. If a superannuation contribution is paid to a segregated bank account in error, it must be transferred to the correct bank account or sub-account within a reasonable period of time. Further, any interest income derived on a contribution is not attributable to the segregated current pension asset and therefore would not be exempt income. Incidental expenses. Apportionment may not be required for certain essential incidental expenses relating to the operation of the fund. The ATO accepts that such expenses can be paid from a segregated bank account without needing to make an adjustment to a non-segregated account. Paying expenses in this way will not prevent the bank account from being a segregated asset. Let's look at an example to clarify some of the previous points discussed here. Here an SMSF has two bank accounts as follows. Bank account 1 is a segregated current pension asset and as such is used to meet the liabilities in respect of pensions payable by the fund. Bank account 2 is held in respect of all other liabilities. The fund holds 1,000 shares in A Limited, of which 300 are segregated current pension assets. The shares are uncertificated and the fund is the registered shareholder on the stock exchange electronic subregister. The fund keeps appropriate records to identify and trace the 300 segregated shares and the other 700 shares. A Limited pays a dividend of $1 per share and makes a single payment of $1,000 to bank account 1 by electronic funds transfer in respect of the 1,000 shares held by the fund. The fund transfers $700 to bank account 2 as soon as practically possible after receiving the dividend. It also transfers an additional $1 representing interest which had accrued in respect of the $700. As $701 was transferred from bank account 1 to bank account 2 within a reasonable time in the circumstances, the Commissioner accepts that bank account 1 will continue to be a segregated current pension asset. As the Commissioner does not accept that the $1 interest was income properly attributable to a segregated current pension asset, the interest is not exempt income under Section 295, 385. Overall, the segregated assets method works best when accumulating assets produce losses for future set-off and pension assets produce exempt income. We will look at an example going forward. Again, what are some of the common problems of segregation? The greatest issue is that it is very difficult to achieve for trustees. It is literally like maintaining two sets of accounts, which might prove to be very expensive for the trustees. Let us now move to the second method for claiming ECPI, which is the unsegregated or the proportion method. The unsegregated pension assets method is based on the superannuation entity pooling its assets and no particular investment being identified as supporting the pension paid by the fund or that part of the fund in accumulation phase. An actuary is required to value the pension liabilities of the fund and determine the proportion of the fund's income which applies to the exempt pension income. The exemption is based on the following formula as specified in Section 295-390 ITAA 97. An average value of the current pension liabilities as a proportion of the average value of the total superannuation liabilities. This is the standard textbook formula. It is worth noting here that although the method talks about the segregation of assets per se, the formula calculates ECPI from the liabilities side of things, excluding segregated assets liabilities. Essentially, an actuarial certificate is needed from the liabilities calculations before lodging the annual return to claim the exemption. Apportionment of expenses of the SMSF may also be required where the pension ceases to be paid as such, where the member commutes the pension to return to the accumulation phase, or where the member has died and there was no reversionary pensioner. The apportion method is not prescribed in the regulation, but we will look at this in detail towards the end. We can now begin to look at some examples to analyze some situations where an actuarial certificate is required and others when they are not. Thus, let's start by looking at some examples. In the first example, member A is an accumulation and has 500,000 balance, of which term deposit is 100,000, property is 375,000, and cash is $25,000. Member B is in pension and has 400,000 balance, of which 25,000 is in units of a unit trust, 350,000 is in listed shares, and $25,000 is in cash. Assets are fully segregated, a clear-cut case, no actuarial certificate is needed. Example 2. Here member A has a pension balance of 500,000. Member B has an accumulation balance of 700,000. The fund has a term deposit of 200,000, property 1 of 400,000, and property 2 of 600,000. Here property 2 cannot be treated as segregated as it exceeds the member A's pension balance by $100,000. Section 295-385 subsection 6 talks about the market value of assets of an SMSF to the extent that they exceed the account balance supporting the pension benefit are not segregated current pension assets. Therefore, the fund will be unsegregated and an actuarial certificate will be required. This is an interesting example of partial segregation. In this example, member A has an accumulation balance of 300,000, comprising term deposit of 25,000 and cash of 25,000, which is 100% segregated. Member B is in pension and his pension balance is 600,000, which includes shares of $100,000 and cash of $50,000, which again is 100% segregated. Both member A's remaining balance of 250,000 and member B's balance of $450,000 are tied up in a real property, the value of which is $700,000. Here, member A's income, such as interest from segregated assets, are 100% taxable, and member B's income, such as dividends from shares and interest from segregated assets, are 100% exempt. A certain proportion of the real property net rental income will, however, be exempt in the proportion of average balances, which are approximately 25 to 45 or roughly 64%. For more details on partial segregation, you may view the ATO determination, tax determination 2014-7. Moving on to a few more interesting examples. Here, two members, both in accumulation at the beginning of the year, start a pension mid-year on 30th November 2014. The assets are completely segregated to support the pension stream. The question is Is an actuarial certificate needed? Have a thought, because the answer is yes, but only for the first time. Next example, exactly the same situation, but the assets are not segregated. The same question, is an actuarial certificate required? The answer obviously is yes, if they are looking to claim the ECPI. And finally, a single member fund is in a transition to retirement income stream, TRIS in short, has an opening balance, pension balance that is, but zero accumulation balance. He receives two further contributions, one on 30th August 2014 and the other on 31st December 2014. Both these contributions were converted into pension accounts on the same date. Here, interestingly, no actual certificate is required for the income year to claim ECPI, as the assets are fully segregated and have not remained in accumulation even for a single day. The entire income would be exempt income. Capital gains and losses are treated differently depending on whether the segregated or the unsegregated method is used by the fund. If the fund only has segregated pension assets, for example, then all capital gains or losses are ignored. If the fund has other income which is taxable, any capital losses on investments which are used to support the pensions are not permitted to be offset against any capital gains which are taxable for other purposes of the fund. If the fund uses the unsegregated pension assets method, then all capital gains and losses are included into the calculation as the formula used in section 295-390 of ITAA 97, based on an average value of the fund's current pension liabilities. The reason is that all the income and taxable capital gains of the fund, with a few exceptions, are used in the calculation. Income which is excluded from the calculation to work out the tax-free income in the fund includes excessive income from some non-arm's length investments and taxable contributions. Also, it is absolutely possible for an SMSF to be in a revenue loss situation. These revenue losses can be used to offset other income of the fund, including a tax shelter for concessional contributions. In the absence of any concessional contributions, these losses are carried forward to the following year. However, if the fund has any ECPI, any carried forward loss is reduced by the net exempt pension income claimed by the fund. The net ECPI amount is the ECPI amount less any expenses that were incurred in deriving ECPI. If the fund has carried forward losses and no member will contribute to the fund in the future, and the whole fund moves into pension phase, all losses, including capital losses, are practically lost. To better explain what we've discussed here, let's now consider an example of how ECPI is offset against any losses. Big ticket SMSF earned $30,000 in interest and paid $200 in bank fees, while 30% of the SMSF's assets were held to provide for the SMSF's current pension liabilities. It has $10,000 in tax losses carried forward from the previous year. The following will be shown on the SMSF's annual return. The gross interest is $30,000. The ECPI is $9,000, which is calculated at 30% of the 30,000, which is the gross interest as there is no other income. The interest expenses that can be deducted is $140. Again, this is 70% of the $200, which is the bank fees. The net ECPI is $8,940. It is the ECPI less the bank fees of $60. That is 30% of $200 incurred in earning exempt income. The remaining bank fees of $60 cannot be claimed as a deduction because they were incurred in earning the ECPI. The tax losses to be deducted from the income are $1,060, which is $10,000, which is the tax loss of the previous year, less the $8,940, the net ECPI. Therefore, the taxable income is $19,800, which is the income less the deductible bank fees, less the ECPI, less the loss. And finally, losses to be carried forward to latter years is $0. Trustees must decide whether they will use the segregated or the unsegregated assets method. It is also possible to use both methods for different parts of the fund or for different pensions. There is no right or wrong approach or legal requirement as to which method should be used, as there are sound reasons for adopting either method. The chart here shows some of the benefits of each of the two methods. Briefly, the reasons for keeping the investments of the fund and using the unsegregated or pooled basis might be cost savings by using the unsegregated pension assets method over the segregated method, or use of the segregated pension assets method results in a greater amount of record keeping for the fund. The reasons for using the segregated pension assets method may include allocating investments to member accounts may solve the perception of who owns what in the accumulation fund. This may, for example, result in fewer disputes over investments and investment performance. The segregation of assets can also result in more efficient tax management of the fund because of the fund exemption provided to income and capital gains from investments being used to provide the pensions. A very apt example I will discuss in the next slide. Number 3, no requirement for an actual certificate where all of the investments of the superannuation fund are being used to provide pensions. This is a considerable importance. Number 4, this may be more suitable for SMSFs where members are of different ages and have differing investment profiles. Now, commencing a pension mid-year can sometimes create a problem. Whilst calculating the actuarial percentage and the exempt pension income deduction, the percentage of ECPI deduction is based on the assumption that the income is earned consistently during the whole year. Hence, it will be wrong to assume that any capital gains triggered and realized after the pension commencement date will be tax-free. Any capital gains realized after the commencement of pension will be part of the total income, and the fund will be able to claim a deduction as per the actuarial ECPI percentage. If the intention is to sell the assets after commencement of a pension, it is of paramount importance that assets must either be segregated or the assets sold the following year. Trustees should take capital gains tax advice before selling any assets after commencement of mid-year pensions. I will use a simple example to explain the tax implications using both the segregated and the unsegregated assets method. If the value of the fund is, say, $1 million, of which 50% is in a property with a cost base of $500,000 on the 1st of July 2013. Subsequently, a pension was commenced with the entire balance of $1 million on the 31st of December 2013. Property was sold on the 20th of June 2014, realizing capital gains of $500,000. Now, under the segregated assets method, his capital gains would have been roughly 250%. That is the 50% ECPI approximately into the 500,000 capital gains. The SMSF would then have had to pay tax of approximately $25,000. However, under the segregated method, his entire CGT of 500,000 would have been exempt. Now, this is the real value of segregation, especially when a large asset is to be disposed of. Which now brings us to the important area of expense deduction, especially when the fund is claiming ECPI deduction. A general rule is that expenditure incurred in gaining or producing exempt income only is not deductible. Expenditure, for example, general administrative expenses of managing a superannuation fund, which is incurred partly in producing assessable income and partly in gaining exempt income, or is on a capital account, must be apportioned. It is important to note here that with segregated assets, any expenses incurred in deriving ECPI are completely ignored, while expenses incurred for the pool of assets supporting accumulation balances would be fully deductible. Tax ruling 9317 talks about a superannuation fund can be receiving exempt income and, indeed, non-assessable capital amounts, the undifferentiated expenses, which are the expenses of the fund that are not attributable to a specific income item, must be apportioned. As a general rule, the deductibility of a complying superannuation fund's expenditure is determined under Section 8-1 of ITAA 97. Unless a specific provision applies, and Tax Ruling 93-17 sets out the Commissioner's views on proportion of the expenditure by which superannuation funds and the types of expenditures that are ordinarily deductible. Subject to apportionment, some of the expenses that can be deducted are the actuarial costs, the accountancy fees, the audit fees, the insurance premiums, the interest costs, the investment advisor fees and the cost in providing pre-retirement services to members, other administrative costs, and supervisory levy. The correct method for apportioning expenditure between assessable income and exempt income depends on the particular circumstances of the case. No single method for apportioning expenditure is prescribed. Interestingly, let's now consider whether an actuarial percentage should be used to apportion common expenses, or will another method provide a much better outcome? Another interesting examples. We're full of interesting examples today, aren't we? Okay, so the fund details are as follows. The concession contribution is $50,000. The non-concession contribution is $100,000. The rollover from the other fund is $450,000, I'm sorry. The investment income is $35,000 and the admin expenses are $5,000. The exempt percentage by the actuary is 60%. Now, if you use the ECPI percentage, the deductible expenses are 40% of $5,000, the admin expenses, which works out to $2,000. But sometimes the actuarial percentage might not give the best outcome. The regulations do not prescribe any particular method. However, Tax Ruling 93-17 prescribes another method of apportioning general administration expenses. The general formula is general admin expenses into assessable income over total income. As per Tax Ruling 93-17, total income includes the total exempt income. So continuing with the previous example, the exempt income is the percentage as specified by the actuary, which is 60% of the investment income of $35,000 works out to $21,000. The assessable income works out at 40% of the investment income, which is $14,000 plus the concessional contributions, which are $50,000. The total is $64,000. The available deduction, therefore, is $3,765, which is greater than $2,000 as worked out through the ECPI percentage method as earlier. In the above example, the formula specified in Tax Ruling 93-17 clearly gives a better result. With that, we finally come to the end of another webinar. I hope you really enjoyed it, and if there are any questions, please email them to me at agni@trusteed.com.au. I shall try and answer them ASAP. So once again, thank you for attending the webinar and hope to see you for the next one. And by the way, we will email you details of the next webinar very soon. So bye for now and enjoy the rest of your day. Cheerio.